Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. So today's agenda, I'll go through the market update. We will review the earnings trades that have populated so far, and then Joe will go through some of his analysis. So let's get started. Okay, NASDAQ NDX that went into state one, Russell still eight, SPX still four. So, we're seeing this kind of divergence before, like we did before. We got one and one, one and eight. So, markets are kind of incoherent. I would say. I mean, if you look at the sectors too, you got communications. So it's like Facebook, Google, energy, uh, technology in one, and then a ton in eight, and a couple in four. So just kind of mirrors here and here. Some kind of market trying to figure out where it wants to go here. Pie wise, we did shrink. We did get bigger on the green pie. So we were at 17 last week. So we're up to 24. Still below, kind of threshold of oversold, which is 30. So, we're still oversold, and we've got a ton in state eight. Over half of our issues are in state eight right now. So let's take a quick gander here at the state percentages. So, we hit that high, and that's right near kind of the at least short-term low here. We're right around 85. So we've moved about 10% as far as bearish, down to 75. Market's still been choppy. This low here was basically when we tested, right around that 1700 for Russell and near the 200 moving average for SPX. So, we just have to keep our eye on it. I mean, still oversold. I think last week, we talked about that 50-day being an issue for SPX, and that held up. So we'll go through the chart here, but obviously this is oversold, and we just have to see if they can get through certain resistance levels, and if the support levels hold, as if we make another run down there. Uh, we haven't had too much in the new lows, although the highs are just uh, just kind of like nothing right now. So we have been getting some interstate ones. So we'll just have to see. But since basically August, September was bad. Pretty much the lows have disappeared, in the past 2 months here. So we got a little bit of spikes, and we'll just have to keep our eye on that. Obviously, big spread, and this mirrors, the overall green pie. So, okay, let's look at the individual states real quick. All right. So this is state eights. We've gotten the state ones, kind of near that low. We were right around 9. Um, so those have popped up a little, not a ton, 6%, but the eights, kind of flatlined up here. I haven't got too much action, you know, topped out right around 56, and we're right at 55. So not a ton of movement there. Still, um, we'd like to see it turn over, kind of like this, like get a nice big drop, to get, kind of bullish movement. The other states, not really much going on. Bearish wise, the twos and fours have been dropping, and that kind of coincides with the ones going up. But nothing going on in the other bullish states. It's kind of a 1 and 8 battle right now. There's pretty much nothing uh, as far as these other states. We'll see. Obviously, not a great day in the market today. All right, so here's SPX. We talked last week about that 50-day moving average, and that's actually coincides right in here, in between 3 and 1. So you can see, just I mean, it was pretty much all week, right? It's just resistance on that level. And obviously we've moved down decently today. And I'll pull that up here just so you can see. Here's the 50-day we talked about. Last week it was 43.81. So it's dropped a little. It's 43.77 right now, but you can see it's 1, 2, 3, 4, 5, 6 days, try to get over that and just butted up against it. So pretty decent down move today. So we're kind of trapped in between this. See which way it breaks out. If the 42, which is the bottom of our range, holds, then we'll make another run up. So we have to get above that 50-day. And that coincides nicely with this chart up here, this range, getting above here. Obviously, we could have a nice bullish run up there, but until we get above that 50-day, we kind of look. Support levels on the way down would be the entry price. Obviously, you can see that provide a good support here. Right below that's that 4,200, which is the bottom of our range. The bottom, and then the top's of 4,600 up here. It's not on this chart, but so here's our key range right in here. Trying to break out above, and if it does get down below, obviously, you see this kind of action again, then it's showing good support. Last time it showed real good support, in this range, 4,230 to 4,200. So that's where we're at with SPX. Let me pull up the chart. I'll just pull it out a little so I can show the the bands here. So this is our 4,200, which held, and then 46, the top end of that range. So I think we're where are we at today? 43, 41. So we're below that EMA, the 43.77, not too far off of that, obviously closer to that than 4,200, but that's what I'd really be focusing on. If we do drop more, 42, if we make another run up, that 50-day EMA has been kind of critical for SPX. That's where I'd focus. So, okay, let's look at Russell on a state 8, in there about half the average days. Didn't make that move down, the average move, but made a decent move down. And you can see we got to 1709.59. So obviously the key level on the downside here, 1700. This is the top of the range, 1900. So on the way up, obviously entry price 1792 kind of area. And then down below, obviously, it's going to be our 1700. That's right near target 1. So that's been very important support. So that's kind of quick on that. Chart wise, we didn't get I think the low was 1709 down here, but obviously that's going to be we didn't test 1700 exactly, but we kind of have the 3-headed monster here. So we did get a lot of chop back and forth. This top, lower high here, barely lower high here, but we made the move all the way back down to the bottom of our 1700 pretty much every time. Here we had chop and then ran up. Here we had chop, longer chop, and then ran up. So I would expect some more kind of this. So, you know, we've already had some little bit of chop here back and forth. So, you know, this one was shorter, this one is a longer chop. So, you know, as long as, I mean, the key is, you know, the 17's got to hold. You know, if we test that again, that's the whole key. And then I would expect, you know, because we're so oversold as far as other conditions, you know, to expect it eventually to run up. But you know, this is the key holding here. I'd say the other key is, you know, SPX getting above that 50-day. So longer term, you know, that's our range here, 17. We've had 3 false breakouts above that. So, you know, down near the bottom of the range, this key is holding 17. And I think today, you know, I mean, we're in the neighborhood, 1736 here. You know, we're still a ways off the 4200 here. But, you know, to the upside, I'd be watching it. SPX getting above 50. You know, if we go down lower, I'd be watching this 1700. So those are the nearest ones. Another one you can look at, I just pulled up NDX because that pulled, you know, that's in 1. So here we got 8, you know, here we got 4. Then this one just went into 1. Obviously, you know, having problems right off the bat with the entry price, you know, it's below there. So that's like a kind of upside target. But what I pulled up the chart, I normally don't look at this one, but you know, it was right on the 50-day. You can see this, the 50-day is pretty important for NDX. So, you know, it's had a few little breakdowns, but, you know, this would be another kind of key level you could look at. 15,017, it's called 1500 ballpark. So, you know, we're right in that neighborhood. So if that holds, that's obviously a good sign too. You know, we're right above that. So this is another kind of thing. Obviously, 200 is like, you know, way down there for that, but that'd be, you know, longer term important, but kind of near term, you know, you can look at the 50 for NDX and SPX, and then, you know, that 1700 range for the Russell. Obviously, it's below, you know, the 50 and 200 for the Russell. But, you know, on the way up, you can also check these levels. I think the 200 is more important for the Russell than, you know, the 50 on the other one. So it's it as far as the major indices. Just kind of pull up a couple. You know, Fed meeting, next meeting, you know, 2 weeks away. Pretty much no hike. But you know, December's, you know, moved you know, kind of towards that hike. So there's a probability that, you know, could get a hike in December. You know, longer term, you know, they're still, you know, factoring in cuts for next year. You know, so we're at 525. So, you know, 50 basis point cut by the end of next year is kind of what's being priced. And that's moved quite a bit. You know, I think it was even lower before, but you know, kind of this range, 425. So it's moved up about 50 basis points, you know, the whole little bell curve here. So higher for longer is kind of the thread there. You know, balance sheet kind of continuing runoff. So we are getting kind of, you know, I talked about this a while ago, you know, like the last time we had this runoff where we ran into big problems. It was about 15 or so. I don't remember exactly, but I do remember 7,500 would be about the equivalent percentage runoff, you know, from the last time I got into trouble. So, you know, still a little ways off that, but, you know, obviously a lot closer, you know, up near 9 trillion. So now we're down to, you know, a little under 8 trillion. So about a trillion runoff. It's quite a bit of liquidity to pull out of the system. So, okay, I had a couple charts. So, we talked about the debt issue, and earnings came out for Bank of America. So this was the June. So these are available for sale debt securities, and they pretty much run it up. So you can see this is mortgage-backed securities. And then, right below that's the treasuries. So this is the loss they had as of last quarter, just on their mortgage-backed securities, if they need to get rid of them. That's like 90 billion. Um, so, and then, the treasuries, obviously, I was like 20 billion, right? So that was a grand total of like 100 billion in unrealized losses here. Oh, this stupid. There we go. Okay. So now next quarter, so this is September, that was June. So now you can see, these are 106. So it's gone up 20 billion in losses on mortgage. And that's just, why is that? Because rates have gone up, right? So rates go up, the price of long-term, like non-floating bonds go down. And then the treasuries also have gone down. So now they have a total loss on their books. This is if they have to liquidate it, right? And they're saying they don't have to. A lot of these things are real long term. This is like 30-year, like these are mortgages, right? These are going to be various maturities, but obviously, these won't all be 30, but that's how most of those started. Some people do 15, some do 30 year mortgages. I don't think they do further out than that right now. Maybe in the future we'll have 50-year ones, but these will be like various maturities, but overall 131 billion in unrealized losses. So, where this, Bank of America obviously is, pretty well capitalized. They probably can hold most of the stuff that, unless there's a big bank run. So, I don't foresee Bank of America having like a big bank run, but this, smaller banks, when they have like big losses, that's what happened with, like Silicon Valley Bank, and people pull their deposits, they start selling these, and then it's just like a crash, because this is throughout banking industry, people they all have stuff like this on their books. But if you look, this 131 billion, if we look at just Bank of America right here, that's their market cap. 219 billion. So it's like 60% of their market cap they have in unrealized losses right now. So it's not a good situation overall. And this is the other one I saw also. I brought this up a while back, cap rates, what people earn on their real estate. And we had talked about, when rates go up. So it's finally crossed over where like the 10-year is, you're getting, 4.6, or I think it's higher now. It's like 4.8 something today. So you're getting more return with like a ton less hassle, obviously, managing real estate just by getting government bonds. So, the smart money, obviously, highest yield for the least risk. That's where things are going to go in the money markets with high rates, with short term, go with CDs. So this real estate is going to be an issue just because people are going to, it's so much easier. I get 4.8, or I can, deal with all this, with the real estate. So just wanted to bring those up. The 10-year, that's a new high. 489, 52-week. So we made new highs today. And, I don't have to pull up the chart. You guys have seen it a bunch. like over 4 or 5, things start getting ugly. Over 5, they are ugly as far as this 10-year. So as far as stock return. So always, this is a big thing I watch. Obviously I'm watching the SPX and Russell for levels of support, and then the 10-year. If we get above 5, I think it could get pretty ugly. So I think that was it for market. Any questions, comments?
It's pretty much what I've been saying. The yield curve has to uninvert, and
Yep.
because we can't stay inverted for ever, and
Right.
it's not natural for it to be.
There's a
And the
lot of
only
unnatural things going on, like all the liquidity and
right,
stuff, but you're right.
the only way that it uninverts to me, because I've seen graphs, I've seen articles that the 2-year yield is heavily correlated to the Fed funds rate. And so the only way the 2-year goes down is if the Fed funds rate goes down. So the other way to uninvert is for the long end to go up, the 10-year.
Right.
And that's the only way I see it happening in the near term. And if the long end goes up above 5, you already stated what's going to happen to stocks.
Right. Historically, I mean, I think, where's that inversion plot? I don't know. And here it is. There we go. So this is like 5 here. So we're kind of like right in this range right here.
Yeah, you're almost there.
Yeah,
the 2-year is what? The 2-year rate is what, 5 something?
5.2. Yeah,
5.2.
it's come. We've looked at that spread quite a bit. That was like 1% difference. So now it's only 0.4. So it definitely, the Fed messaging of higher for longer. These rates, the longer term ones have, moved up quite a bit. Recently. So
I think they got to go to 5.2 at least, maybe 5.25. It's got to uninvert. It's not natural. So when it goes to 5.25 to uninvert, you saw on the other graph, the stock market is not going to like it. And, we seem to be.
I mean, think about the damage on the balance sheets that I just showed you with like Bank of America. Like, if those long-term rates go up even more, I mean, they're going to be looking at losses like, near their market cap, and unrealized losses.
Yeah. There's going to be more of that exposed as we go up. But I just don't, over the short range, like 3 to 6, I just don't see how that yield doesn't go up. It's got to uninvert.
Yeah. Well, I mean, like, so, there's 2 ways. It uninverts, the Fed starts cutting rates, right? So these will start coming down, or like you said, these start, moving higher and higher. So,
Well, if you take the Fed at their word, they're not going to cut. So we'll see in a couple of weeks, but they haven't given no indication they're going to cut. I think there's a lot of people in the market hoping they're cut, but
yeah, I mean, there's still like hikes on the table at this point. It's not.
Exactly.
They're not even.
No way the 2-year goes down. They're saying longer, higher for longer, or we might even have another hike. I don't see how the 2-year goes down. I think it has to uninvert the other direction on the high end, on the long end.
Yeah. I mean, that's the path of least resistance. Like, unless there's some kind of shock or, where they do emergency cuts type thing, but you can't plan for that. Some kind of black swan or World War III breaks out, God knows,
It's like trying to plan for Chile nationalizing the lithium mines that hit us on that Albemarle trade. There's no way to predict something like that.
Well, maybe if you're in Congress, you could got some tips, beforehand.
Yeah, yeah.
All
You would
right.
have to be in
Yeah,
the Tonight.
Josh.
Yep.
Yeah, Robert here.
Hey, Robert.
Hey, how's it going?
Yeah.
Everybody's talking about the yield curve inversion, and I don't know why, but I've heard recently that what we need to watch out is for when it uninverts.
hmm Yeah, that's what Sudhir's talking about. So like here, so when it uninverts, that means these 10-year rates are up here. And that's just, I mean, overall bad for equities, bad for bank balance sheets. Yeah, that's what we're talking about. This uninverts, so this high end, you know, these all move up higher, and we get like a normal, more normal kind of curve like that.
Hello?
Hi, is Pushpa there, please?
Yes, you are speaking to her.
Yeah, this is
Sorry.
Sally at your dental office in Northdale. How are you doing?
Oh.
All right, I got her muted. She's got a dental appointment, I guess. All right. Yeah, so does that explain it, Robert, too? Like all these like longer term rates will go higher up here. So, I think that's overall bad for, the market. Higher rates, higher cost of capital. I mean, people that, just be more expensive for corporations to operate. Their lines of credit, will go from 3.5% to 5.5%, just all that just
Yeah, so I
cascading.
guess it's the same old question as we know it's going to uninvert, just the question is when.
When and yeah, when is the big, I mean, it's been slowly moving, up. So, this was what, and that's why we watched the 10-year, obviously. You know, it was May, it was 3-4. So it's been uninverting as people are understanding, like Sudhir said, that higher for longer, they're not going to cut, that type of thing. So I mean that's a big move for treasuries. 3-2 here. Yeah, we did, like the previous year, we had a decent high up there at 4, and then now we're at 4.8. I mean, we haven't been this high in rates since 07. And this was near the high of 07. We can pull up those charts, but this whole long term since the 80s, it's been all the way down, and now inflation is causing this action. We have to combat the inflation. So at least that's what we're told. So yep. So thanks, Robert. Thanks, Sudhir. Good questions and comments.
This is
Anyone?
Dave.
Yeah.
Dave, I wanted to weigh in on earnings, and I know it's early in earnings season yet, but just sort of the bank so far. But I think Tesla and Netflix are tonight. But I've noticed, and maybe this is just the first week that it's like this in earnings season, where I watch the SPX, and on the days that there are earnings reported and days that there are not earnings reported. And it seems the market is, you can tell it's overly wants to be bullish,
Right.
because it's probably undersold, and at least in the recent month or two. And yet, when earnings are reported, even when they're good, the market has been selling off. So that's not so good. We'll see how next week, and the week after. I think the week after next is when, I mean, most of the S&P is reported by, so we'll see next week's meeting, and then the meeting after, we'll pretty much know where earnings is leading the near term until the Fed meeting. It's at the end of the month. So
Right.
I think that's kind of an interesting tell is to watch the major indices when earnings are reported. Like there's nobody really reports on Sunday or Monday. It's usually they report Monday or Tuesday, and then it's Wednesday and Thursday when you get a lot of the earnings, data to drool
Hmm.
over or analyze or
Right.
overanalyze or whatever. So I don't know. I'm not too sure. I've seen more impact on the SPX due to Fed talk than the new war that just showed up. I was a little surprised at that. I
Yeah.
was watching last Friday's to this Monday's and a week ago is the gold change, Bitcoin change, and as far as hedging goes towards the new war. And I didn't see the new war really affecting all that much. I was surprised though. I was surprised.
Yeah, well, I mean, think about it. It's local right now. It's just like, when you have to start getting real concerned is if it turns regional, right now it's just local, it's like right there in Israel, like local. So if regional players start getting involved, then, obviously it's, it could escalate real fast from there. So, I mean,
Oh,
I'm definitely concerned about it, but, it's still a local thing right now.
yeah, oil prices went up pretty quick though, which they always do when there's any kind of conflict or supply side issue that's publicized, prices go up
Mhm.
pretty quick. Um, so we'll see. That also does not mark well for inflation. The pretty much everybody's expecting the Fed not to do anything at the end of the month, but
Yeah.
there's still a chance they might too. So
Yeah, I haven't seen anything data wise. It's like
yeah,
really, you know, um, I mean, I think the last reads we had were a little above, but nothing like, crazy like we saw before. So
yeah.
I would expect no cut at this point, and data dependent, um, from there.
Yeah, we'll see how the big corporations do with longer or higher inflation for longer goes, because that's I think the theme that's in play, and we'll see how they all do with their
Mhm.
earnings with that
Right.
thing.
Um, okay. Thanks, Dave. Anyone else before we go through earnings here? All right. So earnings trades, we've had some, quite a few pop through. So we had two non-movers. I'll start from the bottom. So one is fast now. So that you can see um, entry price 56, pretty tight range. 57 is the high end of the call, so we're at 60, down a little today. But we got till Friday, so we'll see. It needs to get inside those bands, or could look at pretty bad one overall. We did have Delta, and that did. We had a nice profit on that one. Close it out yesterday. So one down. If I think Fast Snell's down a little today, so I need a couple down days for that to get back in the bands of profitability. So we'll see on that one. Bullish runner. This one's just kind of been chopping around right at the price, so it's slightly up right now. I didn't check on it today, but yeah, so nothing big there. Bullish pre-runners, so quite a few. So we got 5 open. I think this AXP is going to be closing out here. It's kind of right near the entry price. BG had a nice comeback. That was down pretty good. And I think that one's up today. Yeah, it's up a little today, but that that one's had a nice comeback. That was down quite a bit. The other ones here, kind of newer. This one's a short-term trade, so I think this one closes out today. So, overall, the closed trades. So we got 5 that did hit their profit targets here. So nice profits there. And we got 5 open. So, and they keep rolling out. So, we're just kind of at the beginning of the earnings right now. So overall, I mean, this one's up some. I know Sudhir said he had a few close out that I didn't. I think some of them are still out here, but intraday, we don't have the intraday data right now. So this is all end of day. So that's it on earnings update. I'll keep tracking these. And any questions or comments? All right, I'll turn it over to Joe. You ready, Joe?
All right, Josh. Thank you very much.
Mhm.
And hey, everybody, couple charts. Let me grab them. Let's see. When we just a couple things that have been mentioned kind of already. The fact that energy has rolled into state one, both in the ETF, last night, as well as the USO. So yeah, we'll see. Whether it's the war, but certainly a bit of a headwind with inflation in the markets there. Let's see, as far as the ETFs, and, Josh covered it well, obviously, as he always does, just the cross currents between the Russell and NDX, with, state one, SPX kind of in no man's land. But it was, I guess, XLK that went into state one first, followed by NDX, I guess, the next day. So, we'll see whether that continues to be a source of leadership for the market. So, let's see. Following up on last week's conversation about the pie. So we're up to 24% at this point bullish. We did an overall review of, in the 16 and a half years of the database, how many times has the pie been under 15%? And, awful lot of years where there were none, very few years where that happened multiple times. I think Sudhir brought up, some comments about, short-term movements in the market once we get to 15%. And I went back and looked, it was 2022 where 3 times that year, we got below 15%. It was that first May low, and then, the mid-June lows, and then the ultimate low in the market, in early October. In each of those, levels piercing that 15% to the downside, the market rallied at least 10% off of those 15% lows. So we got a rally and then a pullback. And the only other meaningful year where we had, multiples, well, in the last 5-6 years, I didn't go back to 08, 09, partially because of the extreme there, but it was that end of 2018, early 2019, where, again, we had 2 or 3 different periods. Really, it was the end of October and then, mid-December to early January, where we had 2 periods. So in that period, basically the pullback the second time around was 10% lower than the initial of 15% low. So down 10%. Then in 2022, it was 8%. So, not a whole lot of occurrences, but basically that range where we have multiple counts below 15% is new lows in the S&P 8 to 10% lower, which, first thing here is, as Josh pointed out, that 4220 level, one of the retracements just below that, coming off of the COVID lows was 4180. So you know, looking at
Joe.
that 4180.
Joe,
Yes, Sadir?
are
yeah.
you showing a graph? Because all I see is the dashboard.
I just have the dashboard, Sadir. You know,
Oh, okay. I thought
did-
the way you were pointing to the chart, as the way you were talking, I thought you were pointing to the chart or something.
Nope, just, you know, the dashboard for people to kind of get comfortable with that a little bit. You know, S&P, as I say, you know, the and just, it's only been a couple of years where we get, you know, situations where we're under 15%, but the S&P, you know, rallies, basically the rallies have been anywhere from 10 to 28%, and then the sell-offs, as much as down 10% from the first time you get to, you know, 15% or less. So, you know, here we are, we're earnings season. You know, we talk about it all the time. I think that's going to drive things. You know, going and doing a little homework. You know, we've seen the Yardini numbers. He's looking for, you know, year-over-year earnings in this quarter to be up 3.5%. There was a Wall Street Journal article last week. The consensus out of that article, they're looking for earnings up 1.6%. And, you know, the Yardini's consensus, you know, basically is talking about earnings, you know, pretty much being flat, you know, on a comparison basis. That Wall Street Journal article also talked about last quarter, and I guess the S&P 500 earnings were down 2.8% year over year last quarter, and coming into those earnings announcements, the expectation, according to the journal, was they were going to be down 6.4%. So same old story. We get into earnings, it's kind of oversold to the downside. We typically do a little better. So, you know, the journal article talking about earnings being up, you know, 1.3% year over year. Yardini's talking about, you know, something a little higher than that. And as we've been talking about for a long time, the fourth quarter is supposed to be, you know, double-digit gains. So, you know, we shall see. You know, just some of the charts I wanted to pull up. And again, I wanted to go back to the perspective versus the COVID lows. You know, we're bouncing around here in XLK, in state one, and, you know, basically just starting. Just that happened right after last week's meeting. Got a long way to go if we're going to have leadership here. One thing, you know, when we eventually roll out this, you know, new platform, you know, in our maximum move percentage, we added the year. You know, we're going on 17 years of data now. So, you know, we just thought that, you know, having the maximum move is useful, but I think, you know, especially useful to kind of narrow when that happened, you know, so you can race to the chart in 2020 and just see how extraordinary that period was rather than having to go chase it down. So just, you know, we continue to add odds and ends to the new UI, and, you know, one of these days we're going to have it launched for you. You know, I think it was Dave talking about earnings, and I thought I would pull up, you know, you see the term the Magnificent Seven, you know, the seven big ones: Tesla, Microsoft, Google, Meta, Amazon, Apple, and NVIDIA. 5 of those 7 are in state ones. And again, I thought, and the earnings, basically, it's Tesla tonight. Tesla, from what I read, is looking for 73 cents. That's down significantly versus the same quarter last year. I think it was $1.05 a year ago. So I think their price reductions have a lot to do with that, but it'll be interesting to see kind of what happens after the close tonight. Here is Tesla back to the COVID lows. And, you know, so we're kind of midpoint, you know, a little bit of a triangle formation there. And then just wanted to point out, you know, the last couple earnings you know, the last two earnings specifically, you know, you've gotten a negative reaction in the marketplace. So, you know, we'll see whether that happens again today. You know, April was kind of a bit of a low in the market, I think, and July was certainly a top in the market. And so that's the first big one tonight with Tesla. Let's see, Tesla just again, state one, 9 days in state one, typically 36. So, you know, bring it on. Let's see what happens. Microsoft next. Again, there's the perspective going back to 2020. So in state one currently, and 5 days in state one with an average of 40. So long way to go there too. Long way to get to those targets as well. And let me see, their earnings are due next week on the 24th. Looks like they're looking for about $2.65. Google is also going to be on the 24th, also in state one. One of the earlier ones, 10 days, you know, we've been in state one here in Google. And, you know, the longer term perspective, you know, we're banging up against all-time highs for sure. So been pretty constructive with a 1-2-1-2. And, you know, we'll see if that can extend after we get these last earnings. Actually, I'm not sure. Let's see, last couple earnings, basically, you know, last one got a good surprise in the marketplace, and we haven't looked back since. So be interesting to see if we can kind of build off of that momentum in Google. Meta's next, also state one, you know, a little bit, I won't say long in the tooth, but starting to approach its, you know, average number of days. We have her at met target one. And then from, you know, we're banging up against, well, not really all-time highs, but, you know, it's had obviously a great run out of last October's market lows. That's Meta. Amazon is next. One of the few to, well, actually the only, you know, to be in a bearish state, 18 days, been in state two. Typically that is a 10-day situation. So that's, you know, a bit extended, and their earnings don't come out until I guess the end of next week, the 26th. That's Amazon. Two more. We got good old Apple, state three. You know, real short, very few state three occurrences, and see their earnings come out early November 2nd. So we got a ways off there, kind of. Bit of a trading range in Apple at this point, and you know, maybe earnings will be the catalyst to get this thing to move one way or the other. Trying to shrink that, but there we go. So yeah, I've been sideways for quite a while. And then lastly, NVIDIA, last earnings. You know, they'll be out on the 21st. Obviously, that's had a monster run out of the earnings 2 quarters ago. Also with state one, just rolled into that a little over a week ago, and long way to the targets. So I just basically wanted to offer a little perspective, especially going back to those COVID lows with some of these charts. And I think I read most of, you know, probably most people know this, most of the gains this year in the S&P come out of these 7. I think almost the entire, you know, 12.5%, you know, before today. So they were the charts I wanted to throw out there to everybody. Happy to take any comments or questions. If not, Josh, you know, back to you.
Okay. Anyone else? Any questions, comments before we wrap up? All right, we'll close it up. Thank you all. See you next week.
Thanks, everybody.
Yeah.
Thanks, guys.